So we're going to go through my £57,000 portfolio. I've got two portfolios, one with Invest Engine and one with Trading 212. Trading 212, I pick my own stocks, stock picking investment account, whereas Invest Engine is more a ETF account. So in my Trading 212, I have 43,215 as of the date today, which is the 3rd of May. Don't forget to stay around at the end to see how my portfolio is performing against the S&P 500. You could see if I'd invested in the S&P 500 every time I bought an individual stock, what my returns would have been against what they are now on the portfolio where I've picked my own stocks. Currently, my Trading 212 account has a value of £43,215, which is an £8,920 return. And the rate of return is 79.7%. This is a money weighted rate of return. So the way they calculate that is they take into account when I bought, how much I bought, and then they estimate the returns using a formula. So I'll start off at the bottom with my smallest investment, and this is Fair Isaac Corporation. And I only bought £20 worth of Fair Isaac Corporation. I just started a position in it to see how the price would move from that point. So when I entered a position, I just wanted to basically keep tabs on it. And it's a really great company, and my favorite investor loves Fair Isaac Corporation. Dev Kantasaria, if you're wondering who that is, look him up. He's really got a great portfolio, and he's outperformed the S&P 500 for the past decade, I believe. Anyway, if you don't know what FICO Corporation does, you may have heard of the FICO scores. It's basically a credit rating score for individuals, and you need one of these in the US mainly to get a mortgage or any kind of loan. So they have a complete monopoly over the FICO score because it's their score, and it's basically a requirement that everyone needs one. So they're really in a dominant position with the FICO scores. Just from 2020, they've gone up 450%. So, I mean, unfortunately, I missed the opportunity to buy right at the dip, but I, in my opinion, saw other investments that looked like a better value for money at the time, and we'll get onto those in a minute. So my most recent purchase is Meta Platforms. I think it was Thursday this week. I unloaded about £1,000 of my Salesforce investment and put it into Meta Platforms. Meta's had such a crazy journey over the past few years where they were investing so heavily into the metaverse, and investors hated that. And then they pivoted and they've moved towards AI, and it's really paying off for them. Efficiencies in advertising are really increasing. Obviously, the AI is finding some way of advertising to the correct people. Daily active users are still increasing at about 6% per year. And that, along with their efficiency increases, I think that the stock's undervalued. It grew its earnings per share this quarter. They released earnings this week, and their earnings per share were up 30% year over year, which is crazy. Already up 4% on this position. Invested about 1,050. And yeah, up £43. Anyway, moving on. Salesforce makes up about 3.5% of my portfolio. And Salesforce is a company that I think is undervalued at current prices. The reason I've been selling it is because I don't see as much growth in it as other companies. I keep seeing better opportunities. At one point, Salesforce was my largest position in the portfolio. So I was buying around this time back in August and June. And at one point, I had about £4,000 in Salesforce, and it peaked all the way up here. I was up about 40%. If we just have a look here, we can quickly see how much I was up. Yeah, at one point up 50%. I mean, I was really in the money at that point. With Salesforce, and I did trim it a little bit, and I took some of those gains. Not much though. I think I've only taken about 400, maybe £500 worth of gains in Salesforce. Still reasonable considering I've taken that in such a short period of time. in less than a year. Taking a 10% gain in less than a year is pretty good. And I obviously still have 1,548 still invested in it. With Salesforce, it's one of those where I just believe that it is trading at a really high free cash flow yield. And that's understandable because the revenue growth has really slowed down recently to about 7.6%. Whereas previously it was sitting, over the 10-year, it's 21%. You had years here where it was really like pushing the 30% range. So with Salesforce, my investment is really dependent on them continuing to increase efficiency. At the minute, they are really rapidly increasing free cash flow because Mark Benioff, the CEO, has said he's going to really make Salesforce an efficient company, and he's proving that is what he can do. I may continue to sell it as I see other options in the market that I believe will give me a greater return. But for now, I'm holding steady with Salesforce. Moving on, my next largest holding is Visa. With Visa, I was buying in the 254 range. It's now up to $347 per share. And I'm up on that initial investment, 34%. However, my foreign exchange impact, which annoyingly we have to consider during my investments because I'm from the UK, so all of my investments in dollars are adversely affected when the pound increases in value and the dollar decreases in value. So at the minute, I'm losing about 5% on all of my investments just because of that foreign exchange impact. But nevertheless, Visa is just such a strong company. I have Visa and I have Mastercard, and I'll sum these up together actually because I bought them around the same time. Mastercard, I've got a similar gain, about 37%, and then with the FX impact, about 30%. So looking at both of these, they are the duopoly in the credit and debit card industry. And when I say that, I mean they are basically a toll on all of your credit and debit card transactions. Every time you pay for something, they are taking a little cut. And I just think that's an incredible business to be in. If we have a look at their insights, they have some of the craziest fundamentals. It's just so consistent. If we have a look at Mastercard here, they grow revenue consistently in double digits, 13% last year, 12% over the past 2 years. And their free cash flow is so consistent. I mean, over the 5 years, 13% free cash flow growth. Over the 10 years, 16.16%. So with companies like this, you can expect their price to double once every 5 years. If you've got a company growing free cash flow at 16% consistently over a 5-year period, they're going to double every 5 years. Moving on, we have Booking.com. Booking is one of those highly debated companies where a lot of people say it's a really high risk sector because the travel industry gets hit straight away when there's a recession. Now, I believe that it may be hit harder during a recession, but the need and desire for people to travel is never going to go away. If we hit a recession and less people travel for a couple of years, so be it. I know that 2 years later, when we start to come out of that recession, there will still be a demand for travel. It's an innate human feeling. They just want to explore and see the world. And Booking really has a monopoly especially on the European travel side of things. And Europe is just such a highly sought after destination for travel. Also, if we have a look at Booking holdings, you can see that they trade at a ridiculously high free cash flow yield, 5% and then 4.66% after stock-based compensation, which is really, really high for a company of such quality. But what really I love about this company is their free cash flow growth. So if you look at free cash flow per share, it gets even higher. You're looking at 16% over the past 10 years and 22% over the past 5 years. And that is because they are so strong at returning capital to the shareholders. So if we have a look at their shares outstanding, they are constantly buying back shares. So every year, say they buy back, like last year, they bought back 4.65% of the total outstanding shares. In theory, my shares should increase by around 5% because of this. They've bought back 5%, so my part of the pie has increased. This also shows that the owners and the CEO believes that they are undervalued, which is a great thing to see. But they have performed really well for me, up 25%, so a £576 gain. And then obviously if you take the 4% FX impact off, then we're looking at a 30% gain from where I bought in. Right, moving on from booking, we'll skip Mastercard because we've already been over that. And we'll have a look at ASML. ASML is in the red, about £303, which is not bad. It gives me the opportunity to buy more. I believe that this company is undervalued at the minute, especially as I'm down from my current position. ASML is one of these companies that is essential to the chip manufacturing industry, so the semiconductor industry. With the AI boom, I do believe that ASML will pick back up, as it really has a monopoly over the machines that create and etch using ultraviolet light these incredibly powerful chips. The word on the street is that their technology is about 5 years ahead of anyone else in the game. So it's almost impossible to compete with them, especially on the scale that they can make these machines. They have crazy operating margins because they can create these machines, and because they're the only ones who can create these machines, they can then sell it at such a huge profit margin. ASML is a cyclical stock though, because it will go through periods where everyone is buying the latest machine so they can create the latest chips, and then they will hold on to that machine for a little while and produce the chips with it, and then there'll come the next wave of purchases through ASML. So it's taking a dip at the minute, but we're just going to have to wait until companies like Samsung, TSMC, and Intel decide to start buying in the next best machines produced by ASML. I have about 3,200 in this position at the minute. I originally invested about 3,500, so we'll see how that pans out over the long run, but I really do have a lot of faith in ASML. Next up is Texas Roadhouse, one of my best performers. This is just a restaurant with incredible efficiencies and huge demand in the US at the minute. Everybody loves an affordable steak, and that is exactly what Texas Roadhouse provides. Now, they are great at opening new locations and instantly just getting queues out the door and people just being fully booked. People just want to go in there. People want to buy. So I bought down here. So this was where, I don't know if you've heard of Wegovy and Ozempic. They are weight loss drugs. They were announced back here in June of 2023. And this caused restaurants and fast food chains to drop in price, and during this time I was buying into them. I saw, when it came to Texas Roadhouse, I knew that these weight loss drugs, they wouldn't just completely overwrite the market, and people aren't just going to stop eating or going out for a meal. Going out for a meal is, it's a special thing to people. It's a special thing. You go out to socialize, not just to have the meal. And you're not going to be put off doing that because of a weight loss drug. Now, when it comes to Texas Roadhouse, it pays a 1.46% dividend. What's great about Texas Roadhouse is they consistently grow revenue in between 10 and 20%, about 15% year over year. And their free cash flow growth is also incredible. I mean, if you look at the 5 years, you got 20% year over year. And if you look at the stock-based compensation, it's even faster. 25% over the past 5 years, 25% over the past 2 years. It's just an explosion in free cash flow, which is really great to see. You can see them continuing to add new locations. So they keep adding about 6% in terms of number of new locations. Okay, so moving on from Texas Roadhouse, we have Netflix. Now, Netflix is my best performer in the portfolio, up £1,597 from my original £2,200 investment. Netflix has just been absolutely great. For some reason, back here well, back here we had a little decline in the amount of subscribers to Netflix, and that sent the stock from 651 down to 180. I wish I bought back then, because that would have been a crazy time to buy. That would have given me some huge results. Anyway, it then took about 3 years until the stock really came back to its prices in 2021. So I actually bought here, it went up, I sold a little bit, it dropped, I bought here and bought more again. I sold so I could put some money into another investment of mine. I just took quick gains on it. In hindsight, I should not have sold any out of it. I should have kept all my money in it. So I probably took about 1,000 out. So I would be looking at about a £2,000 gain if I didn't sell £1,000 of it at the peak around here. However, I am really happy with this. It's 73% upside. And then if you add the FX impact, you're looking at a 78% gain from my original purchase. It's currently had an amazing earnings and is flying. So I think there'll be a point soon where I've doubled my money on my Netflix position. They are just so consistent. They are well ahead of the competition when it comes to streaming. And yeah, that is my Netflix position. Moving on to my next stock, I hold S&P Global. Now this makes up about 10% of my portfolio. So we're moving into the category of 10% positions. And S&P Global is a 10% position for me. Now, if you don't know what S&P Global does, they are in various industries, but the two that they're mostly known for is they rate debt for companies. So they'll give you a debt rating of, let's say, if you're a really strong company, you'd get a AAA rating. And now this costs the company money. You have to get a AAA, or you have to get a rating from one of the big companies, either S&P Global or Moody's. They have to rate your debt. So you have to have a rating in order to acquire or take any debt out. So this is a duopoly that they function in, and they traded lower during this 2022 period as interest rates rise. So seeing this, the thesis was, if I buy in, I started buying in around here, and I've been buying ever since it's gone up to here. I've been buying up here as well. I do believe we will still see substantial gains from S&P Global. Its other business it is in is the indices. So you've definitely heard of the S&P 500, and they own that indices. So when a company like Vanguard, for example, tracks the index, they then have to pay S&P Global a percentage of the assets under management, which is really a strong business to be in. If you haven't seen my most recent video I did on MSCI, they do a similar thing, but they don't have the debt rating business, hence why I'm invested into S&P Global and not MSCI at the minute. S&P Global has given me a return of £603 and it's up 16%. My gain overall from where I bought in was actually 21%. Take away the FX impact, which is actually quite high on this one, about 5.5%. And you're looking at a 16% gain. Now, moving on from S&P Global, we have my third largest holding, which is Uber Technologies. I have about 5,600 in Uber, and I am 1,178 in the green. This has been a really great investment for me. I bought in around December time, buying in at the lows of about $60, $63.38 is my average price. Now this has been really great for me, not only because it's up at the minute, but because during the tariff season where Donald Trump was tanking the markets with his tariffs, Uber performed really well for me. It never dropped below the price that I bought in, and it was just it held my portfolio up and allowed me to just relax and just not panic. And it fell, and now it's peaked straight back up to $84, which is great for me. Gives me a £1,400, and then obviously a 5% FX impact has brought that down to 26.48%. Uber is one of those where it dipped because of Tesla's announcement of autonomous taxis, but realistically I think that Uber is going to be the key aggregator of all of these different autonomous taxis like Waymo, Zoox and Tesla. and they're all going to be asking Uber to be on their platform because they provide all of the demand. Those are my brief thesis on Uber. Uber at the time, I'll have a look at Uber. If we have a look at Uber, I still think it's trading attractively for a company that is moving really fast. If we look at the free cash flow growth, they've gone from highly in the negative to rapidly growing positive. Yeah, I entered at a really great time with Uber, really got the bottom, and I think it's only up from here, to be honest with you. I think autonomous taxis will make it more efficient and not less efficient, and people will be asking Uber to be on their platform. Now, moving on, we have my most heavily invested company in such a short period of time, which is Hims and Hers Health. I've made several videos on Hims and Hers, and it's my most exciting investment, I think, by far at the minute. I've been investing so heavily in it over the past 2 months. Unfortunately, I entered a position at about $42. My initial position, it was about 2,500, which is about half of the amount that I have in there now, and it was $42, and then the price really dipped. So if you have a look at some, like, the bottom here, it made it to 22.74. That was a huge loss for me at the time. I was down about 1,500 at one point on Hims. I didn't panic, however. I continued to buy in because I just think it's still undervalued, I believe, even now. I wouldn't be surprised if I saw it at $50 by the end of the year, or higher. But I continued to buy during this dip, and I've managed to lower my average price to $35.76, which is good. It's not as good as some of my mates, though. I asked that. I said to them, look, you should buy into this company when it was sitting around the 26, 27, 28 mark, and they managed to buy in. I wish I had more cash, and to be honest now, I wish I sold my Salesforce position at the time during the Trump tariff dip and bought into Hims and Hers Health. That would have been a crazy investment, almost up double basically from that position, which is crazy. But hey, you can't get everything right, can you? So Hims is a risky play from me, and they've got a low free cash flow yield, but this is because they are growing their revenue so incredibly fast. Over the past year, they've grown it up 70% year over year. So a 70% revenue increase, and their free cash flow is growing at just insanely fast. So from the end of 2023 to the end of 2024, they went up 305%. So they quadrupled their free cash flow. And I believe that even if they just give us the same performance again, which is 150 million in free cash flow gain again, then we're going to be looking at a free cash flow yield of about 3.5%, which would just be, the company would just be undervalued, because you shouldn't have a company growing at 3.5%, growing revenue at 70% and having a 3.5% free cash flow yield. If you want to know more about Hims and Hers, you should watch my recent video about Hims and Hers. It goes over why why there was such a peak, and then why it crashed so heavily so quickly based on some weight loss drug related announcements. So with Hims and Hers Health, I have about £6,000 in the position, and I'm up about 10%, which is £580. Luckily, I've got less of an FX impact on this because it's a more recent investment. Moving on to my largest position, which is Amazon. I've weighed them so heavily in my portfolio. When I say so heavily, they are making up 15% of my portfolio. Yeah, I've got about 6,500 in the position, and it has a 6% gain, which is £404. Now, I think that the market is undervaluing Amazon, and they still have a lot of efficiency levers to pull. Their high investment in CapEx is weighing down their free cash flow amount, and I believe that they will essentially completely pop when they transition to pure profitability and they stop reinvesting, which maybe never, but one day they might decide that it's time to start feeding the shareholder back a bit of the profits that they are making. Now, you can't really value Amazon using a free cash flow yield just because they invest so much in CapEx. So you could see this rapid growth in free cash flow here. That shows you what happens when there's less investment in CapEx. It can go from highly negative, where they invested so heavily in their distribution, to stupidly positive. That swing there is insane. They've gone from negative 30 billion to positive 50 billion in a matter of about 2 years. So that is such a quick turn. They can just so quickly flick that switch and make the company incredibly profitable. I think that it's hard to value Amazon, and people struggle to do it. And that's why it's so consistently undervalued. So this brings my total portfolio to about £43,215 with an £8,920 gain and a 79% rate of return. Now, the average investor cannot beat the S&P 500. So this is my portfolio benchmarker, where I put my portfolio up against the S&P 500. And basically what this does is it calculates where my portfolio would be if I had just invested in the S&P 500. And over the past 2 years, over this time, I've been about equal with the S&P 500. It overtook me a few times. In fact, it was ahead a little bit, quite a few times. And then from about July, the end of July, my portfolio began to outpace the S&P 500. And at the minute, I'm outperforming it by a percentage difference of 15.27%. Now, I'm really happy with this. This shows that my research and the stuff that I put time into is actually worth doing. My investments in Texas Roadhouse and Netflix, Uber have really paid off. I think that Hims is going to be the next one to really pay off. And I think I'm going to see some big movements from Hims. Hopefully I can increase this gap even further. A 15% increase is just so good, just over the past 2 years, and I'm really happy with it. Now, my last video was really highly edited and I put a lot of work into it, and it took me many hours and it completely flopped. So I'm going to change my strategy a bit. I'm going to start moving towards more consistent, more informational posts, basically about my portfolio and how I'm performing, what stocks I think are a buy, and maybe cover a little bit of investment news. So we'll see what happens, but posts will definitely be more consistent. And yeah, I'll see you in the next one.